Hi everyone, Matt from Stocktrades here. Hope you enjoyed last week's video around yield on cost. Dan's video generated lots of discussion across all our platforms, and it was certainly an engaging topic. This week, we're going to talk about stock splits. Is a stock split a good thing, a bad thing, or a non-event? Today, we're going to look at these companies, and we're going to let you in on a little secret. There's nothing to get excited about. First, let's look at the basics. What is a stock split? In simple terms, it is when the company splits its shares based on a set ratio. Think 2-to-1, 3-to-1, 3-to-2, those are the most popular. Using a 2-to-1 ratio as an example, a 2-to-1 split means that the company is doubling the amount of shares. So for every one share of the company, you will now have 2 shares of said company. Now, since a stock split is simply that, a stock split, there is no change to the fundamental value of the company. And I'm going to say this several times throughout this video. Since there's no change in the fundamental value of the company, the stock price will in effect drop by 50%. The simplest way to explain it, let's say you have a $100 bill and someone then offers you 2 $50 bills for said $100 bill. At the end, you will have 2 bills instead of 1 bill, but the total sum of the money you will have is still $100. Same principle applies to a stock. Suppose you own 10 shares of a $100 stock. Post-split, you will now own 20 shares of a $50 stock. The end market value is still the same, $1,000. Based on that example, you might be asking yourself, what is the point? Great question. We're going to come back to it. There's another type of stock split that I wanted to introduce you to, and that is the reverse stock split. This means that the company will decrease the number of shares. Suppose you have 10 $10 bills. The equivalent would be if someone were to offer you one $100 bill for your 10 bills. The end result, you still have $100, but instead of 10 bills, you now have 1 bill. Once again, the same concept applies to a stock. Suppose you have 10 shares of a $100 stock. In a 10-for-1 split, you would now own 1 share of a $1,000 stock. In both cases, the value of investment doesn't change. It's still $1,000. Now, let's get back to the original question. What's the point? If the value remains the same, why would a company split their stock? The single most attractive aspect of a stock split is that it reduces the company's share price. So it will either cut it in half, it might cut it by a third. And in turn, the theory is that it will boost liquidity by making the stock more accessible to the common investor. It has everything to do with the psychological aspect of investing. In fact, it is something that retail investors are most susceptible to, and is one of the reasons why retail investors tend to underperform, because they let emotions and their psychology get in their way. As mentioned earlier, there have been 2 stock splits announced this past month, and by high-profile companies at that. The first one being TELUS, they announced a 2-for-1 split, and the second being Brookfield Asset Management. They announced a 3-for-2 split. These announcements are somewhat of a rarity. Although it used to be a popular trend, stock splits aren't nearly as relevant today. Since 2015, there have only been 4 large cap TSX listed companies to have announced a stock split. That's a very low number. One common misconception around stock splits is that a boost to liquidity will equate to a boost in the value of the company's shares. Too many times we've heard retail investors say, wait for the stock split or get in now before the stock split, because once it splits, the share price will rise. This is a flawed assumption. True, there are several cases where this will happen. Take Canada's big banks, for example. They have a long and storied history of stock splitting. Their success is well documented. However, to be quite frank, in reality, the boost to liquidity is temporary. And for TELUS and Brookfield Asset Management, the impact is not going to be that drastic. At the time of their announcements, TELUS and Brookfield Asset Management were trading at approximately $57 and $85 respectively. At those prices, any retail investor who wanted to invest in these companies could have done so. Anything under $100 is not really a barrier to entry for most retail investors. Another flawed assumption? Those thinking that if they wait until the stock splits, they'll be able to buy more shares. True, in theory, you would be able to buy more shares, but if you buy those same shares today, they will split. So you'll effectively have the same amount of shares after the split, whether you buy today or whether you wait until the split to buy. To those thinking that they will be able to buy more shares post-split, they are missing the big picture. The value remains the same. That means that price to book, price to earnings, price to sales, company's expected growth rates, all of it remain constant. The only thing that changes is the number of shares. Oh, but at a lower price, the stock can double faster. Nope. Once again, that is a false assumption. Using TELUS as an example, it is expected to grow at a mid-single digit rate. Assuming the company's share price grows in line with that rate, it will double at the exact same rate, whether it's worth $60 a share or $30 a share. The growth rate remains the same. Oh, but I'll get a higher dividend. Nope. Once again, that is just plain wrong. In a stock split, the dividend also splits. So the yield effectively remains the same. TELUS shareholders are getting $2.33 per share on an annual basis. Post-split, they'll get $1.16.5 per share. The end result is the same. If you own 100 shares of the company, you will receive $233 of income on an annual basis, same as you would post-split. We've heard many investors say history has shown that post-split the stock price rises. We did a little bit of research on that. As mentioned previously, there were 4 large cap companies to have split their stock on the TSX since 2015. Care to guess how many of those were trading above the split price 1 year following the split? Not a single one. So why is that? Because ultimately, the company's share price will rise and fall based on its performance, based on its valuation. It has nothing to do with the split itself. Interestingly, companies still fall for this, as do retail investors. Case in point, the last company to announce a stock split, the last big company to announce a stock split was Dollarama. They did so in June of 2018. One of the reasons, and I'm going to use the words of President and CEO, the main reason for which they decided to split their stock was, and I quote, to improve liquidity and make their shares more accessible to a broader range of investors, especially retail investors. It all sounds great, doesn't it? However, in the year following the stock split, Dollarama had significant volatility. In the end, its share price closed down 10% post-split. In fact, it is still down approximately 15% from when it split the shares back in June of 2018. So, does a share split cause the stock price to rise? No. At the end of the day, it's all about company performance and valuations. In theory, attracting more retail investors should mean more buying power, right? So more buying pressure should increase the price of a stock. So why isn't this happening? The reality is it's not an effective strategy anymore. Schwab did some research on this exact topic back in 2018, and they found that between 1993 and 2016, the amount of stock splits south of the border, so on US markets, decreased by 93%. And they listed several reasons. For one, the advent of ETFs. Do-it-yourself investing is actually on a decline, and ETFs have made it incredibly easier for the common investor to invest in the markets. So the end result is if the target is individual retail investors, that is now representing a smaller and smaller piece of the broader market. In such case, it's not enough to move the needle. So even if there is increased buying pressure by those retail investors, it won't be enough to move the needle in any significant way. Secondly, those with the power to move the markets are institutional investors and funds themselves. And to them, a stock split is quite frankly irrelevant. Another reason they gave was that high-flying technology stocks have now made it, if you will, a status symbol to have a high share price. Think Amazon, think here in Canada, Shopify, Constellation Software. All these companies are trading at very high stock prices. Now, in the past, this may have prompted the companies to split their shares. And when your stock price gets that high, there is definitely some relevancy there to attract retail investors, even though, once again, the fundamental value doesn't change. However, in today's markets, a high-priced stock is actually viewed as a measure of success. It's a status symbol. And that alone is enough deterrent for those companies with a high stock price not to conduct a stock split. There is, however, only one real significant factor behind the price action post a company's stock split. That is the performance and fundamental value of the company. Full stop. Circling back to TELUS and Brookfield, if you think that TELUS or Brookfield are good buys today, then don't wait. Buy them. There is no reason for you to delay that purchase until post-split. Likewise, If you don't think they make good investments today, then don't buy them post-split. Unless something fundamentally changes that all of a sudden changes your mind as to whether or not these make good investments, then don't buy them post-split simply because they are half the price or a third of the price that they were previously. You're buying based on a false assumption. It all comes down to fundamentals. I hope you enjoyed the video. If there's anything that you think we missed, please mention it in the comments. Thanks for watching. Please hit the like button, subscribe to our channel, and click the little bell icon to make sure you get notified of our next video. Till next time.